All right, we are starting. Guys, today we have with us a very versatile investor, Anish Moonka. Presently, he's a research associate at CEO's office at Hike. He has got 6+ years of independent equity investor, and many of you who are connected with his handle are already aware how versatile and how vocal he is about his investment and his theories behind that, and particularly pharma space and IT space, he keep a very great view. And as far as educational background is concerned, he is an IIT graduate in manufacturing science and engineering. So welcome Anish to our platform, and it is great to have you today.
Yes, thank you. Thank you so much for inviting me, Prince. So it feels good to be able to share my thesis. Yeah.
Yeah, great. So, guys, we'll be starting with the introduction, like how it started for Anish, and we'll be asking about his top bets and what's the rationale behind his investment. And I have added few speakers. I request them to be on mute till the time we ask them to open up for their questions. So, Anish, would really love to know how it started for you. What motivated you towards investing arena, and how it started for you.
Absolutely, like happy to. So for me, investing started like much before I was born. So for example, my great grandfather used to invest in the stock market. Somehow he started learning about this in the 1940s and 1950s, and then he got like absolutely fascinated by it at that point in time. And he was like one of the few investors from a small city that I belong to, Jamshedpur. And he somehow started investing so aggressively. Every particular money that he used to earn, he used to put in the stock market. And due to uh, due to his health problems, he had a very early demise, due to which he wasn't able to, you know, allocate a lot and build the positions by a lot over his lifetime, because he was into stock market just for 10 years. But the money that he invested, when I became capable enough to understand what is happening on the portfolio side of my family, I understood the level of compounding you can see if you are into the great companies for really long periods of time. And that is something that happened in my family. The very very small amounts that he invested, it became humongous. And that in my early days showed me as to what is the power of compounding and what is the power of finding great companies and holding on to them for really long periods of time. I understand the timelines today are much smaller compared to what they used to be previously, because the disruption is something that is happening in every industry. So that is something, that's why we have to change with time. That's fine. But on an average, the power of compounding, that one particular concept, was pretty much clear to me just looking through my portfolio and how it behaved over the last 4 5 decades, his portfolio. And then once I started my college, I got into it, and basically I totally got enthused by it, and all of my time was invested in learning about the stock market. And that's why I wanted to build a career in it, and that's how we are trying to build a portfolio and rejigging it. I'm managing some people's portfolios, and that's how I got interested in it. So coming on to like what my investment thesis is, and like what my philosophy is behind investing. So obviously I'm targeting a high alpha when I invest. And because at the end of the day, I can get a 15-20% CAGR if I go through the traditional means of mutual funds and other ways, which I do not want to go at this point in time, because I'm allocating so much time into it. I'm interested in doing this, and for my time investment, I would require a high alpha. And that's why, to do that, I follow very simple rules of like passively investing in aggressively large positions in some of the stocks that I focus on. So let's break that line. What does that even mean? So, what do I mean by passively investing? So, it basically means that being patient for my thesis to play out. So, businesses are always uncertain. And at most times, even the entrepreneur or the founder has little idea what will happen 6 12 months down the line. And this is the case like most of the times. Thus, I prefer to not give a very high weightage to the short term expectations that I have. However, I'm pretty ruthless about the business being in the right direction. So is the entrepreneur walking the path that we previously aligned on from a year to year basis, not from a quarter to quarter basis? That's like too short a timeline in any business. For example, if there was an external issue, then that's fine on my books. That is not a worry. And obviously that at most times gives us an opportunity to load up more. For most of the manufacturing companies, for example, today they are facing very high raw material pricing pressure. But we all know that when the raw material prices do go back to normal, which they already have started to, their margins will come back to normal. And if they have a lot of capacity which can get utilized, then you know that this might be a good bet to look at if the valuations are reasonable today. So that's sort of a basic common understanding, that common sense that I use to like choose companies and then load up on them. So if but if there's a structural problem, then we should be like extra cautious, and that is something that I'm working on these days, to how to sell, perfect the art of selling. That's the most hardest part that I have to deal with, because once you have put in at times like 50 100 hours in a company, at times it gets very hard to convince yourself. You develop a lot of biases which you have to work against. So that is something that I'm working on. So a second point that I do is like aggressively large positions. So 10-15% of my portfolio will anytime be in any company which I have like very strong conviction in. So I believe like once you have done all the checks, like read through everything that is there in the public domain, and by everything I mean everything. So whether be it annual reports, con calls, value picker thread, YouTube videos about the management anytime in the past, tweets, everything. And you have also done the due diligence via meeting the management, talking to their employees, talking to their suppliers and customers. You can easily reach out to them through LinkedIn and just ping them on Twitter, wherever you find them. And most of the times they are okay with having a conversation about the business they are a stakeholder with. So in a nutshell, you have to know more than the 95% of the investors who are out there interested in this particular company. Then only you can create that edge. Otherwise, like if we are reading the same things, then at the end of the day the edge doesn't get created. Or else like you should have a much higher longer term horizon, and you understand the moat of the business much better than everyone else. But that also is very rare. It takes a lot of time to build that. And once the company meets all the checks, then I am rest assured of taking a very large position. I mean, well, it sounds great to diversify across like 10 different mutual funds owning 100 stocks each. However, I believe the real wealth is created only by owning concentrated positions in a few stocks for a long period of time, where you have that strong conviction that this company has that market opportunity and the management has that fire in their belly to continue to grab more market share. That's the basic philosophy that I go with. Obviously there are like hundreds of different philosophies in which you can make money in markets, but this is something that makes sense to me given my basic human nature. So that is something that you have to align yourself with what works for you. For some people, obviously the volatility that I have to deal with in my concentrated portfolios would not be optimal, because they are just not able to grasp like a portfolio can be down 30% in 6 months. So that is something that you need to question yourself and then decide what works for you. And but this is something that works for me. And to put in the work to understand which company makes sense to which company is like relevant for me, I need to have a very strong high barrier, and that's what I follow. So basically that stock shouldn't be the talk of the town. It should be misunderstood in some way or the other, such that I can get a growth hungry management at a valuation multiple that is not already capturing the upcoming growth, which is a very common occurrence these days in our markets, where an FMCG company which is growing at like 10-12% gets a 80x multiple, 80x price to earnings multiple. So what that is saying to you is that a lot of the future growth is already getting priced into the stock. So I prefer to not go there. I prefer to at least go for companies, even though their PE might not look great today. I want to go for companies where a lot of future growth is not priced in. And you will see that with mostly all of the companies that I'll discuss today. and I'm planning to discuss like five stocks, which approximately make up like 50% of my portfolio today. And I'm basically thinking about expanding them to 60% in the next 3 months. Possibly not, but as per my expectations of the certain inflows. So should we start, like, Prince, discussing my first company, and then we can go forward, and like we can go company by company, and once a company is discussed, we can ask people to ask their questions about that particular company or the industry, and then we can go to the next company.
Right, right. Totally makes sense. And also, I would like to know, like, we often have various kind of biases. So, how you alienate them from the conviction you had in your bets? Because biases at times, our conviction might end up on the wrong side, and it run a great risk being in a concentrated portfolio. So, also like to know your view on that front.
That has to happen. A certain level of bias will always be there. You have to be biased in a certain way to make money, because if you'll go and ask like hundreds of people in the market as to why I shouldn't buy this company, or like I'm buying this company, you go and tell them, they will have 10 different reasons. You can tell me any company. So Prince, you can like just give me any of the company from the 5,000 companies that are out there, and I'll tell you 10 different reasons to not buy that company. Anyone can do that. So what you need to eliminate the most of the like dangerous biases is to have a very strong trusted investor group that you trust. I mean, basically a trustable investor group which you can go and run your ideas with. They will allow you to see the same company from different multiple vantage points, and that's where you improve your thesis. They will tell you about which are the risks that you are not able to think as of now. They will explain you each and every, because you are discussing these companies with a trustable group of friends or investor friends that you have. You'll be able to eliminate most of the white spaces that you are missing today, and that is something that helps me a lot. Like, I have like 5 6 friends who I continuously discuss my investment ideas, and they help you improve in every manner, I believe.
Right, Anish. So, guys, a small disclaimer: any names taken during the conversation will purely be explaining his thesis and for educational purposes only, and those should not be construed as any sort of buy, sell, or hold recommendation. So, any questions you have, you can ask. And Anish, we can go ahead with your top five bets and the rationale behind that. We can go one by one. Yeah.
Yes, so I was thinking I'll start with my highest conviction bet, which is IDFC First Bank. So basically, I've been following this company since its capital first days, before it got merged with IDFC Bank. Since 2016, I believe, the year I started investing. And it took me 6 years to build my position. Why? Because I am learning about the company, I'm seeing the direction in which it is going, but it made sense for me to go big only over the last 12 to 18 months with the developments that happened. So yes, the future is always bright, but you also need to match your narratives with the numbers to some extent, and obviously buy them before like 80 90% of the numbers come in. Once you get like 10 15% of the numbers into the picture and you see the direction is fine, then you can go forward and get in. And normally market takes time to understand these sort of stories where the perception initially is extremely bad. So initially the bet was majorly on the jockey, Mr. V Vaidyanathan, and his entrepreneurial journey, and you know how he created capital first, struggling to get VC funding just after the great financial crisis. And I liked the integrity that he displayed with which he did business in multiple scenarios, which we will discuss. However, like, things really changed for the better in the last 1 year. So recently their retail book has crossed over 1 lakh crore with a 1 crore customers. So building such a franchise, pan India franchise in retail, where you have 1 lakh crore plus loan book, it's extremely hard. So, you know, as unseen value Sajal sir always says, you have to look for companies which are very hard to copy. Why is he so bullish on Syngene? Because for any company to copy Syngene, it would take like 15 years for them to reach where Syngene is, after putting in a lot of effort, a lot of resources. And that is something that you can see with Capital First. How many Indian financial institutions are there who have a diversified retail book with 1 lakh crore size? There are very, very, very few. One of the names could be Bajaj Finance, HDFC Bank, but how many others are there? ICICI Bank, but very, very few of them. Even Kotak was small on the retail side. Recently, it has started to scale that part. But to build that on an NBFC and then making it a bank, it just sounds too good to be true, and that's what has happened here. So yes, there's a very high gestation period. They have already reached that, but we need to understand like what's the basic philosophy. Like, why do we need IDFC First Bank or a Capital First when we already have like Kotak, HDFCs, ICICI, Axis, SBI? What's the need? So to understand that, I'll just give you an example which I went through recently. So there's this company in US, SoFi Technologies, and currently it's listed. It has a $5 billion market cap. So when it started in 2011, it came from Stanford as a startup. It saw that there are like two groups of people. So there's a students from Stanford and there's a students from a regional college, and both of them are getting educational loans at the same rate. But once they went deeper into the numbers, they saw that the students from Stanford have a default rate of less than 1%, but the students from other regional colleges have a default rate of 20%. So why are they getting the same rate? Because there was regulations, there were big banks, legacy banks who didn't want to change. Everyone was following a simple system, and that's why we require more and more new financial institutions who can think in better ways, who can make this whole complex system. So in India, it's a very complex country. It's like 130 crore people. You need there can't be just 10, 15 financial institutions who are serving all the financial needs of these many people. So you want more entrepreneurs who can think out of the box, who can do a lot more data crunching, who can go for the last mile connectivity to reach the people who others will not, who the largest of the largest will not, because some of the largest make money in like wealth management, so they don't really care about like making an MFI loan and going to the uh, you know in the lowest of the lowest village. It's just not possible for them because they are not they have so many things to focus on already. So basic fundamental was we needed a lot more financial institutions, and to do that they focused on this term called exclusion grid. So bankers make a lot of lines before they start to give you loans. There are age and tenure restrictions, so some banks will only give you home loans for like 10 years or more than that. They will only lend in like X and Y locations. They will not go to A and B. They will have many much more conditions. They will have an LTV of like 65% or whatever. They will want your company to have like 5 crore turnover and 50 plus employees. I don't know why, but these are some sort of rules that banks have created over time. And that's where IDFC understand that we do not have to follow some of these rules and still we can make money. There are some people who are getting excluded by the banking system, which we can reach, and we can give them loans at a little bit higher price, which is like 300 400 basis points higher than HDFC and Kotak, because obviously the cost of fund of IDA Capital First was much higher. But still we can provide them credit, we can provide the lever to become big. What is leverage? It's the lever. The lever part needs to be focused on. It just provides you to become big, well, helps you in becoming big. And that's what leverage does, and that's what they started providing to small entrepreneurs and small small employees of small companies, home loan, personal loans, and other type of financial products. And that's how they started, the main basis of Capital First. And they were able to capture the profitable customers. So in banking, BFSI industry, the growth is not something that you need to always focus on. You also have to also focus on that the growth that you are capturing, is it profitable or is it a loss? Every single unit that you are capturing, it could be a profit, it could be a loss. If that person doesn't give you the loan back, it's done. So you need to be extremely prudent in doing that, but that doesn't happen overnight. that takes a lot of iterations, that takes a lot of data crunching to understand which are the segments which will become profitable for me, or which are the places where I have to not go. So even in a small city like Jamshedpur, there are XYZ areas where the default rates are extremely high. So you, over time, you will understand that, and then you will stop lending there. That's what Bajaj Finance and IDFC First banks are doing across India level. So they are building that sort of they have built that geographical moat, and on top of that, they are also building a data moat, which is creating a very strong IP for them, which is not really easily breakable. And while the larger peer, Bajaj Finance, gets a multiple which is much higher because of that, IDFC doesn't, and we'll try to understand why it doesn't get that. So basically, they tried to reach new segments, and in the initial days, what happened was they were experimenting with a lot of new products. For example, they started giving gold loans in 2014-15, which didn't work for them, and they got out. And that's why you will see that Capital First in the initial like FY13 to FY16-17, they had a lot of write-offs. So that is something that always comes up, that the lending quality wasn't that great in Capital First. But people don't consider that they were just starting up. They got their major funding in 2012, and on top of that, they started building businesses. And those businesses take time to mature, and they take time to build that IP, as I mentioned. So that's what exactly was happening. They were just going for businesses that were working and just writing off the businesses that were not working. Extremely ruthless in doing that. And that's how they perfected the initial days. So people talk about like the book not being seasoned enough. I do not agree to that, because majority of the loan categories that now make up the majority of the book, they have already been seasoned enough and worked upon on a pan India level from FY12 to FY17-18. And this is what is the 1 lakh crore book today. In total, it's like 1.4 lakh crore, because there are other like infra loans and wholesale loans. We will come to that. But the 1 lakh crore book that you see on the retail side, that has been already been worked upon multiple times. Obviously, they are going into new products today, and that's sort of an experimenting they are doing. They are also giving like buy now, pay later loans. So this is a sort of the type of management that you're dealing with. They will always go to new areas where they think that the potential is there for it to become humongous. And what exactly happened was like the IDFC and Capital First merger, when it happened, the retail book was only 50% or less than that of the total book. Currently, it's over 74%. And slowly and steadily, this whole retailization of the book has happened. While the retail book was 50, less than 50% at the time of the merger, and wholesale and infrastructure book was the rest, that book has collapsed like anything. So Mr. Vaidyanathan understands it very well that their capability is on the retail side. And that's where their 95% of the focus is going. Infrastructure, they will decrease to zero, which they have already decreased from 22% to 5% now. And majority of the book where they see pressure, it's already being provisioned. Same for wholesale, like they have provisioned 97%, up to 97% of their wholesale book, which has gone bad. So you can understand that provisioning and everything is done. Major focus now is on the retail side, which is now 74% of the book that has already been seasoned enough. And then there's a question about the lending quality on the retail side. So I'll just give you a basic idea. So before, in the Capital First era, they used to borrow at 9% rate, and they used to give loans at 16 to 18% rate, because you understand why, because they can't compete with the large banks. They have to find new white spaces for them to lend to. Today, their cost of fund is now down from 9% to 5%. How did that happen? A very funny story. So when they did the merger, their CASA ratio was less than 10%. CASA ratio of a bank is the current account and savings account deposits. And these happen at a much lower rate compared to the total like term deposits. For example, if you go and open a fixed deposit, you will be charged, you will be paid like 5-6%. But if you open a current account and savings account, for current account you will pay zero, and for savings you'll get zero, and for savings account you'll get 3-4% rates. So that was a part where IDFC was extremely weak when they merged, and that's why the cost of funds even after the merger was pretty high. So people really questioned them ki, how will you do it, how will you achieve the 30% CASA rate that you are targeting in the next 5 years. Today they have a CASA ratio of 50%. How did they reach that? So basically they started giving 7% interest rate on savings CASA, savings account at the start. And still, like, people had their questions, even I had my questions, at how sustainable that is. But to my surprise, they were able to decrease the rates from 7% to 4-5% today without any decrease in their CASA ratio. And that this jump from 7% to 50% happened over a time of like 3 to 4 years. Kotak Mahindra Bank, which is one of the most known banks in India, one of the trusted ones, they took 12 years to build their CASA ratio to 60% where it is today. Other smaller private sector banks are not even at 40% CASA ratios. Most of them, even City Union is like 30-35%, RBL 30%, and others are also similar to that. This company did that, and now their cost of funds is one of the most competing with respect to the small to mid-sized private sector banks. Obviously, the large ones, the HDFCs and SBIs, are much better even today. They are like 3-4% cost of funds, but IDFC has decreased their cost of funds to 4-5% approximately, and it will go down further. So basically, they decrease their cost of funds, and now they can lend to much lower rates, and that's what they have been doing. Now their lending rate on average is 12 to 13%. So by that very logic, they decreased their credit cost because now they are lending to more much better customers. Same, you can see it in multiple numbers. So reduced their new to credit customers, so people who are getting the credit for the first time, from 20% to, I believe, 9% today before the merger. They decreased the people who are less than, they decreased lending to people who are less than 700 in terms of their credit bureau score. Previously it was more than 40% of the loans were given to people like that, but today it's like less than 15%. And in multiple ways that has started to reflect on its numbers. So even when the COVID hit, where majority of their book was from the previous era, where the cost of funds were pretty high, and that's why the lending quality, the quality of people that were getting the loans was not that great. They were able to maintain their credit cost at 2.5% in the worst of the years. And this is something that is as good as the best of the best lenders who are in the retail focused arena, which is even Bajaj Finance. So their credit cost was very much similar to Bajaj Finance in over the last FY20 and FY21 and FY22. If we take on just focusing on the retail side, because the wholesale and infrastructure had its legacy problems, and that is something I believe has created a bad narrative for IDFC in the earlier days, because they had to take a lot of write-offs. So they weren't, I think this is one of the mistakes that they did when they merged with IDFC Bank, where they were not able to understand what is the exact loss they would have to incur with respect to the infrastructure and the wholesale portfolio of IDFC Bank. And that's where some mistakes happened. I understand that. But now that is out of the picture. All the legacy loans are out of the picture. Everything is provisioned. So you can understand that Vedyanathan at times is a bit aggressive in terms of lending, but then he's extra aggressive in terms of provisioning. If he understands that yahan par kuch problem hai, if he understands that that portfolio has any issue, he will provision it 2x faster than anyone else. He was the first one to provision Vodafone Idea book, which no other bank in India did. He's extra cautious in those ways. He was the first one to raise money when COVID hit. And second, it was followed by Kotak Mahindra Bank. He was the first one to take a 30% salary cut when COVID hit. And other than that, Kotak Mahindra Bank did it. Uday Kotak also did it later on. So I think there are only 2-3 banks who did that when there was a very big crisis. Because when COVID hit, no one knew what will happen. Even the best of the bankers had no idea as to till when will it go and like what sort of credit costs they will incur. But still, when we see the numbers now, with the benefit of insight, the numbers are great for IDFC, to be honest. at the peak, IDFC's retail loan and GNPA went to 4%, from 2% average to 4%. And you can also see it in Capital First's like 8 years of history. Their NPA, GNPAs never went above like 2.5%. Never. And we had demonetization, we had GST, which had a strong impact on the MSME sector, if you understand. Still, nothing. So you can, there are a lot of stories behind that this is happening, that is happening on the IDFC First, but it's not getting reflected in the numbers. And what we are seeing in the numbers is that like it's extremely surprising. So the collection efficiency pre-COVID was used to be 99%. Today it's 99.5% on average. EMI bounce rates pre-COVID used to be 9-10%, which is similar to what Bajaj Finance says. Today it's 7%. So in multiple ways, in SMA, SMA1, SMA2, you can see the same trend. So in multiple manners, you are seeing that it's getting much better even from the era of Capital First. So now they have like the 4% extra differential in terms of cost of funds, and they are passing on to the customers to get a very higher quality of customers. And with my recent channel checks, IDFC is also lending to the best of the best customers in terms of prime home loans. Why are they doing that? Because still they are not at all competitive with respect to HDFCs and SBIs of the world. They want to capture the customer as fast as possible, and once you are captured, you will get a lot of liabilities from that customer. Normally, we have seen that the customer who has a home loan with a particular bank, they will keep a lot of liabilities with that particular bank. They will buy a lot more financial services from that particular bank, and you generate fee income, you generate other loans that you can sell to them. So it's a very long-term game that you're thinking. And obviously, over time, when the mindset with respect to people view IDFC First Bank, and I'm not talking about investors, I'm talking about normal people, the trust will develop. Today it's not there, obviously, because it's a very new bank. Like comparably, it's like just 5 years old, like 4 or 5 years old, compared to a legacy bank which is like HDFC, SBI, which is like 25 and 100 years old sort of a bank. So that trust obviously is not there today, and that's why they can't like get money at like 3%. But that is something, that's a journey that we have taken. The second question that always arrives is that IDFC First Bank has a very high cost of capital, cost of doing business today. So cost to income is very high. So then you have to see it in the context that when they started, when the merger happened, they just had like 200 branches. Today they have 650 branches, because in India you won't get liabilities without branches. It's just not going to happen. People do not trust you otherwise. So they had to invest in those branches. And normally in banking branches, what happens is that the break even happens in 2 to 3 years, and the real money making, the ROE, comes after like 4 to 6 years. So majority of the capital has been invested today. Now is what you're seeing is an operating leverage. Now you're seeing is that the results look great, and this is happening, that is happening. So this branch network today is like loss making. It will turn profitable. So that will drive the operating leverage. When they started, you have to see the trajectory. When they started IDFC First Bank, they had a cost to income of over 100%. Today, it's down to 73%. And over time, they're targeting to take it to 50-55%, which is very much normal with respect to the high cost business that they do. Obviously, in retail, retail loans, the cost to income will be a little bit higher, because you have to invest a lot into the infrastructure to reach to the customer. But one, keep that in mind, that to go from 1 lakh crore book to 2 lakh crore book, they wouldn't have to double their infrastructure. The infrastructure will go up by 20-30%, and majority of the incremental revenue then will go to the bottom line. And that's how operating leverage plays, and that will be a thing which you will see in majority of the stocks that I'll discuss today. And that's what everything is going in the right direction. The provisions are done. The loans given after the merger, so for example the wholesale loans, they are giving some wholesale loans because they want to keep wholesale loans at like 10-15% of their total book. Other than that, they are also cross-selling wholesale clients a lot of products which are like cash management solutions, where they already have 3,000 clients, which is growing at a very rapid pace. They have wealth management solutions, which is growing at 97% year over year. It's already at 7,000 crores, and it can continue to grow at a very high rate for a long period. So now on the existing branch base, they are building many products. So if you are a customer of IDFC First Bank, you will now be receiving a lot more calls as to buy this product, that product. And that's what they have been targeting over the last 1 year. And it's already started to show in the numbers. So the branch network will thus become profitable. Other cost that is creating a ruckus for them is the high cost of liabilities. So previously there was an infrastructure institution. No, IDFC Limited was an infrastructure institution, and then they DFI, and then they created this IDFC Bank. So due to that, they used to take like 10, 15-year, 20-year loans at very high rates, at like 8.5, 9% rates to fund the long-term loans that they are going to give on the infrastructure side, so that asset liability doesn't mismatch. So to do that, they already had this liability book, which is humongous, like 40,000 crores of liabilities, which were at an extremely high cost when they did the merger. And this liability is slowly getting depleted. So whenever this the loans that they have taken from the market at like such high rates, it's coming for giving the money back. They are continuously giving the money back, and currently it's down to from 40,000 crores to 22,000 crores by the end of this quarter, which is at a very high rate. So just this liability will get replaced by low cost deposits, which are like 4, 5, 6% rate deposits, and that differential will add like 1,000 crores to their bottom line in the next 2 to 3 years. So that is another cost that they are bearing because they were a DFI. But now going forward, it's slowly getting depleted at a very fast pace. So that's also going out of the picture. Thirdly, they're also losing money in credit card business. So if you observe, the credit card business is, I think, like 15 to 18 months old, and they already have reached 1 million cards. But with credit cards, what you see is like there's normally a very high operating leverage, but that comes later into the picture. Firstly, you have to give a lot of fees, and you have to give a lot of perks to capture the customer's mind, and slowly and steadily he will miss his payments and stuff, and then he will give you money back. So, so to build that revolver base, it takes a lot of time. So that's what will happen here. And you will see that the credit card business will turn profitable over the next few years. So there are three different cost pains today, which are branches, which are high cost borrowings that they have, and the credit cards. So this will go away, and you can see it in history. Every bank which has performed well, they are able to manage down their costs. And IDFC on top of this will continue to grow their book at 20-25%. So the growth on the book side will continue to happen, and the degrowth on the high cost side will continue to happen. So there will be a massive jaw opening, and that's your profit. And that's what I think Mr. Vaidyanathan continues to talk about. The retail book will continue to grow at a very high pace, and the liabilities is already done. On top of this, what I want to discuss is that yes, so we have already focused on like how IDFC is very much new compared to the older banks. But slowly and steadily, as and when their assets mature, they also will be very similar to the larger and old banks in terms of the ROEs that they generate. Another thing is that IDFC's business inherently is very much unit economically is much better than the larger banks. They are basically 90% into retail today, 75% today, but then they'll become 90% in the next 3-4 years into retail, and that retail business has a very high ROE in terms of the unit economics. But obviously, you can't see ROE in a single year. You have to see ROE over cycles, and I have done that math. So if your business today in the retail side, IDFC is doing 18 to 20% ROE, let's just forget about the extreme costs, which we have already discussed, will go away with time. That 18-20% ROE over a cycle where you're like 4 good years and 1 bad year, that bad year will make the ROE go down to like 2-3% if the credit cost is as bad as what we saw in the COVID downfall. So COVID was like once a century sort of an event. And if that happens again, I'm just assuming that will happen after 5 or 4 years. Your ROE on average is nearly 14-15%, which is comparable to the best of the best. Kotak's ROE today is like at 14% across cycles. So you can understand the math that I'm talking about. So in every sort of way, like today, the valuation today for IDFC is like 1.5 times price to book. For an average private sector bank in India, it's like over 3 times. So you get the differential is always there. The misunderstanding is there. You are getting a bank where unit economics is much better than the others. So it becomes a no-brainer to a large extent. And to understand like what sort of culture and what sort of tech stack they are building, you have to go a bit deeper. And you can always come back to me, and we can have a conversation as to what exactly are they doing. But there are multiple layers to it of my thesis where you will understand the modes and the IPs that they are building. And that is something that is working. So let's talk about some antithesis then. I think we have already discussed a lot of theses. So an antithesis, obviously, there's a very big key man risk. You're always buying the banker. You are never buying the bank. That's the main statement that you need to consider. So V. Vaidyanathan, if he leaves IDFC, then that's a thesis killer. So that will be a very important thing. The legacy issues can come up again, but I don't think they should. They haven't really proven themselves on the wholesale lending side. So if they aggressively grow on that area, I would be extremely cautious. They haven't really proven it to me till now. So any macroeconomic risk, something like COVID happens, that sort of a thing will always be a case with banks because they are so intricately connected with each other. Even if like one of the banks fail, every bank will crash. So that's how you have to understand like any macroeconomic risk. If you see that it's coming up, then you have to be cautious. Currently, the credit cycle is up. It's already showcasing 5-year highest growth, and I'm hoping that it's going to pick up from here. We have already seen 4 years of pain, which is very rare for a growing economy like India. Normally, to give you some context, credit growth of any economy happens at 1.5 to 2 times of nominal GDP to support the growth of an economy. If an entrepreneur wants to do a business, he won't be able to get the money to do the business if there was no credit. As we talk, lever. He will not get the lever to become big. So we need leverage, and that's where credit comes into the picture. That's where a lot of white spaces get created because the large banks can't do everything. And that's where IDFC comes into the picture, Bajaj Finance comes into the picture, and you have seen the wealth Bajaj Finance has created. IDFC has created a similar infrastructure, but yes, the multiple today are not there. And that's what is the arbitrage that I'm trying to capture. And basically, another thing that I like here is like the tech stack. The just go about and using the interfaces that IDFC is building, and over time they have improved it by a lot, and I'm believing they have to improve from here too. But with the culture behind gets showcased in the sense that they are willing to invest big to improve that experience. I had a recent experience where I gave some lower rating in their app due to some issue, and I got a call like in the next week as to what was the issue, how can they improve, and stuff like that. So that sort of UXR team doesn't really exist in most Indian banks. That was something was very surprising to me. So yes, so they are also investing in a lot of new verticals. I believe I'll just discuss them. Yeah, so one of the things that I'm seeing is that they are also building the fee income in a very big way. Digital cash management solutions, over 3,000 clients. Trade forex, they are growing at a rapid pace. Wealth management, they grew at 100% year over year, and can grow like that for a really long time. 6,500 crores AUM already. Fastag, they are like 8.5 million fastags issued. They are, I think, second or third largest in India, or even the largest. Toll acquiring business, they already have 420 toll plazas. So, and credit cards. So basically, I'm telling you, it's like they are thinking in multiple manners, not just lending. Lending business will continue to churn cash flows for them until unless there is like a COVID type of crash that happens, which can create problems. But until then, uh, until a down cycle on the economic level happens, they are fine. And that's I think I have completed my thesis there. Basically, the person behind the tech is Mr. Madhi Vanan Balakrishnan, and he is renowned in terms of the technological evolutions at ICICI Bank before that. So he was the CTO of ICICI Bank for 10 years before that. So, and over the last 3 4 years, you can understand like the work that he has done for us to get the products that we are getting from IDFC First Bank. Another thing, like final thing that I want to discuss, the ability to ship products. I'm actually fascinated with which like their ability to bring new products, new changes into their applications and stuff. Like this is something that's not really seen in Indian companies a lot. So that just a few things. But yes, if you have any questions regarding IDFC First Bank or the banking industry in general, I'm open now.
Yeah, Anish. So, Ravindra, any questions or contra view, or shall we ask Deepak to ask his question?
Yeah, I have a question. Thanks for giving me that opportunity. Can you hear me?
Yeah, Deepak, ask your quick question. Yeah.
Yeah. So the question means after getting all the knowledge from the Anish, I have a follow-up question in the banking industry. So suppose how to cut down stocks in the or the getting to a one or two maximum stocks or the shares in banking industry, because when I see the whole industry, I see HDFC Bank as a bigger one. So there is a I get attracted to that. Then IDFC Bank is a turnaround story and how they're building up. I'm completely agree with Anis. So that also looks attractive. Another one is the AU Small Finance Bank. That also looks attractive to me. Okay, so how to minimize means basically how to cut down or shortlist the one I just want to hold, because all three are looking good to me.
Yeah, great question, Deepak. So the thing about like holding banks is that you should, if you're starting up with understanding the banking sector, you should always go for the bank Nifty index fund. So there are a lot of ways in which you can directly invest in the whole sector to capture the upside. And normally, it's a sort of a cyclical business because majority of the banks will be cyclical. You won't see a lot of cyclicality in the largest of the largest banks because when a down cycle happens, they don't really have that very high credit cost where like majority of their book goes away, which happens with a lot of NBFCs and small banks and small finance banks, which will happen. So you should focus on going through an index route if you are not able to understand exactly how every bank is working on a granular level, and it's a black box. So a BFSI industry, you can most of the times you will never know what is exactly happening. In a bull market, everything will get pumped up, whether be it a housing finance company, whether be it a NBFC, whether be it an unknown company which suddenly got acquired by some big house and something happened. So everything will get pumped up and you will never know what exactly happens. A company like, I don't even want to know the name, but like it had extremely shady lending, but in the last cycle it went from 30 rupees a share to 300 rupees a share, and it happens. So when the credit cycle will pick up, every bank, every lender will showcase a 25, 30%, 40% growth, and you will never know what exactly is going on inside. So that's when I said you have to buy the banker. So if you trust the integrity of the banker, if you have seen the history of that banker and you understand why he took the decisions that he took, then you can go for it. And obviously the largest of the largest are at the best place because their cost of funds is so low, they will always get the best of the best clients. Like for example, me, like I would never go take a loan from IDFC First Bank today because I can get a very much cheaper loan from SBI or HDFC Bank. So from to get to me, IDFC will take I think 5, 7, 10 years, and I won't default. I can assure you of that. So so that journey for IDFC First Bank or RBL Bank or whatever XYZ Bandhan Bank, it will take them a lot of time. And if you are starting up in this sector, I would prefer you to go for a bank Nifty or just the largest of the largest banks, as you mentioned, HDFCs, Kotaks of the world.
Yeah, Anish, so one follow-up question, one is small. So if I go by the Bank Nifty or some Bank Nifty fund, okay, then won't I miss the alpha? Because in the Bank Nifty is the average down of all the stocks on the weightage, right? They have in the index.
So yes,
So
it
if I
will be
want
a
to capture the
cyclical thing.
alpha also, what I should do?
So basically, first thing you have to understand the macro cycle. So currently, the credit cycle is up, and we have already seen 3 4 years of pain, as I mentioned. So now from here on, the all the banking industry stocks will do really well, and that will be your alpha. Like everything will do well. It's just that you have to get out before a lot of like euphoria starts getting created, which will happen. That's how the whole cycle works, where you are
Anish, I think we lost you. I
Anish,
could
we are not
hear.
able to hear you.
Is it better now?
Yeah, I can hear you well.
Okay. So yes, as I mentioned, the banking industry will always be cyclical. So once you're buying a bank nifty fund, then you have to get out in times of euphoria. Currently, no one, I think before 6 months, no one wanted to even touch the banking industry, and that was the time to get into it. And now is the time to just hold on to it. And even if you add in today, it's fine, because it's like we are just at the cusp of the bottoming out part, and we are just seeing like 2-3 quarters of good banking industry numbers. It will take the cycle normally is much longer. So now is the time to just hold on to the index, and then you have to sell that to make money. Obviously with IDFC I have a much longer horizon, which because I think that they can transform from this cyclicality to a much more stable zone, but today they are not there. So that is something that you need to keep in mind. So yes, I think that clears your question, I believe.
Right, Anish. So Ravindra, you can go next. Yeah.
Yeah, I don't have any specific questions. I interacted with Anish about a month or two back, and we discussed many stocks. So, and we exchange our notes on IDFC as well. The only view I have here is, say, nowadays, now banking is more or less like a commodity, and banking reach is also being everywhere. So one thing which I see as a segregation from a different all the bank is whether they have this new age growth engine or not. Something like insurance, is there insurance business attached to the banking company which we are thinking, or something like so because of why I'm bringing it here is, say IDFC, they had one IDFC Securities, which is a bull market product. They sold it to DAM, Dharmesh Mehta entity. And then there was a mutual fund which they are now about to sell, or the sale has already been executed. They are about to sell it to Bandhan. So that is one thing which hit me at the back of my mind, that they wanted to focus, IDFC wanted to focus only on the core banking side. So that is one part of the risk. I guess I have discussed this with Anish 2-3 months back, but I wanted to bring it again. And other thing which, Anish has it as his highest allocation, but yeah, I stack it at a lower level. My thought process was different. I will put the larger ones at the top, but that is only to do with what kind of comfort level you are bringing in. The other question, there was one question about how you stack your investment within different banks and all. Look, bank, Anish mentioned it very right. You will know all the bad things which has happened with any institution when nothing is left. Uh, Before that, तो पता भी नहीं चलेगा कि what is the issue. Say if you pick a RBL bank right now, also if you gauge on the numbers, you can't say there is that much of the problem has been reflected on the share price. So banking is like you have to see how they have performed in 2-3 bear market, and then take a call whether the practices are good or not. Otherwise, there is no way you can call from the numbers. Other thing is, one thing which I keep tracking on IDFC is, what I feel is they are bit more aggressive than what it should be on the banking side. Say if you even listen to their last or previous con call, I guess they were saying that we will be 2x of the size in next 3 years, and then post 3 years will be about 5 lakh crore AUM, and loan book, and after that also we can grow at the same pace. So that kind of thing is actually you need to keep at the back of the mind, that now they are not a small bank. Now their loan book is about 1 lakh crore. Their retail side of the growth, they achieved some 75-80,000 crore loan book. So now they are not that a bank which you can consider on the sideline. They are pretty much a mainstream bank, the larger banks that you can call them. So now the growth has to be adjusted with. Otherwise, in the banking side, if you grow so fast, now then there is lots of blind spot, and that only you can discover at the fag end. You can't discover at them at the beginning. Other thing which I actually, since Anish is here, Anish, did you take a look at what is their fee income pot as a percentage of PBT? Because this bank is going more on the MSME and the retail side. So what happens is a bank which have a balance on the corporate and the retail side, they will have a decent fee pot, which is, say, if you pick HDFC Bank, I guess 70-80% of their PBT is the fee income, and good portion of that is from corporate side. So what kind of fee income as a percentage of PBT they reported, if you have the number handy, otherwise I can also look at last quarter, because that gives a sense whether the ROE would be so easy to sustain or not. The other thing is, yeah, they will do much better. Yeah, the thing is, their retail NIMS is above 6-7%, and they right now they started bringing down their cost of loan. Uh, what I remember is even now every 6-7 months, what they are say Kotak did a 6%, 7% kind of saving rate for at least 10-12 years. They started somewhere 2005-6 and continued it to 2015, I guess. IDFC traversed that journey from 2019 onwards, and they completed it. Now they are trying to prune the interest rate on the savings side. So they are very quick, and cost of fund will come down very quickly in next 2 years. So retail loan book, if they continue to what generally banks do is, once the cost of borrowing is lower, they move to a better pedigree in terms of their customers as well. They lend to better customers at a lower rate. So your risk adjusted NIMs comes is not moving significantly. You take a lesser NIM, you are lending at a lower rate, but the risk profile of your customer is significantly lower. That's how they should operate. But otherwise, yeah, decent one. The only thing is the allocation one can consider how much he is comfortable with. Like other person was asking, what happens is probably not only on bank or any other things, where you build your conviction with research now. Every bank will face drawdown. Okay, now if the economy hits a lower growth rate or something happens, again there is FI selling, every bank will have significant amount of selling. If you don't do your research prior now, what happens, say about 2-3 months back, IDFC hit about 30-35. Those times you will panic. But if you have done that reading, then that gives you conviction to hold during the bad times. Otherwise, during the bad times, you will exit. So those things, if you have ready, it gives you conviction to hold, and then you can ride on the growth journey. That's it, yeah.
Yeah, thank you so much, Ravinder ji. Are you able to hear me?
Yeah, Anish, go ahead.
Yeah, so basically, yes. So as you mentioned, some pointers, I would just like to add some things there. So on the thing about like IDFC Securities and IDFC Mutual Fund. So these were entities which were from IDFC Limited. They were not into IDFC First Bank. So the culture, obviously, from the start, there was no matching. And after that, like IDFC, what they have done is like they have gone and collaborated with many institutions where they are trying to get fee income from there. So they do not want to go directly into opening a brokerage account. They do not want to go directly into opening a mutual fund, because that will then create another business vertical, something which is very much different from the banking industry. While they can just use that base that they have built to sell these products to their customers, and that's what they are targeting to do. Secondly, on the IDFC becoming more aggressive in terms of lending. So I just want to share one data point. So 10 years back, the whole lending sector in India was 30 lakh crores. Today, the credit base is 130 lakh crores. With the growth that India is projected to see on the GDP level, on the base side, and the credit growth that should be expected on top of it to fund that growth, the Indian credit market will be 400 to 450 lakh crores by the end of this decade. So you get an idea as to like with the opportunity size, I believe IDFC there will be a very big humongous opportunity size, because the retail and MSME today are, I believe, 60% of the total credit in India, and that is where majority of the under penetration is there. So if you go and talk to Tata, every bank wants to lend to them. Every financial institution wants to lend to them. But if you talk to a supplier of Tata, which is like a tier 4 supplier of Tata, something related to that, very few will be there for him to get leverage. And that's where these new sort of institutions, smaller banks, medium-sized banks, IDFC First Bank will come into the picture. Obviously, the risk is higher, and that's what you have to price in into the book. Coming on to the fee income side. Yeah, today the fee income is a bit lower, as I mentioned, because they were not really focusing on getting the fee income till the last 1 year. Why were they not focusing on? Because of the simple fact that they didn't have any liabilities. So they reached 50% CASA last year by March. Before that, they were extremely furious as to getting those liabilities. Anything else was on the back of their mind. Once the liability base is strong for a bank, then you can do whatever you want. Most of the bank failures in the world happen due to liability failure. It rarely happens due to asset side failure, because people lose their trust in the bank. They go and take the money out, and then the whole pack of cards have their fall. And that is something that he wanted to secure. And when he secured, now he is building on top of it with a lot of multiple cross selling of products and this and that, in terms of building their fee income, and which you will see in the upcoming days, where majority of the, if you see in the Capital First days, majority of their income was coming from fee income, because that's how the business model is. That is even valid for Bajaj Finance. It's a very similar business model in that sense, at least for the core core products that they do, for example consumer finance and stuff. And one more thing, like today, not a single segment of their loan book is more than 10 to 15%. 15% for the hires, like home loans, and for normal loans like personal loans, it's like capped at 10%. On the new like collaborations with terms of tech related companies, fintech companies, IDFC is one of the most open to do that. They are lending BNPL with Cred, they are lending BNPL with Flipkart, they are lending BNPL with Amazon and other companies. They are one of the most open in terms of the banking industry. Other one is like AB Capital, which is an NBFC. So they are trying to find more and more ways with which they can grow. So 2 days back, like I activated my Ola buy now pay later, and that's there also I got a loan from IDC First Bank. It got sanctioned. So in multiple ways, as you mentioned, I think most of the things are getting addressed by the management with time. And yes, they are a bit more aggressive, but I think if they are able to manage their credit cost in one of the worst down cycles of the last century, which is COVID, and even today they are improving their quality and pedigree of customers, you will see that in the next down cycle, I believe they will be able to absorb this cost a lot better. And obviously, most probably, it will not even go to losses, because in the next 3 years, they are going to improve their cost to income a lot more. So they will have a lot more bandwidth to take the losses, which will eventually happen in the next down cycle. But I am of the belief that no one will even think about that in the next bull market. So we might get an opportunity to see an extreme optimism too in the bank, which at which time obviously some selling should happen. So what we saw in the last 1 month was an extreme pessimism. I had no idea why did the stock went from 50 to 30, but when it was going there, I was buying. While the people who haven't really built the conviction, as Ravindraji justly said, they will panic, because wherever I saw, there was this question as to there might be something wrong. There has to be something wrong, otherwise why the stock is following? And that is something where your brain plays a lot of games with you, and it gets very tricky. But results came, and then you know what happened. So should we move on to the next company then, Prince, or do we have any other questions?
Yeah, Anish, we have Sharan. We can take one question if you feel right.
Yes, please.
Yeah, Sharan, you can unmute and ask a question.
Yeah.
Go ahead.
Hi, Anish. How are you?
Hi, Sharan. I'm great. Tell me about you. Like, how's it going?
Yeah, yeah. Yeah, it's going good. Yeah. That's what. Thanks for sharing your investment journey and thesis. Yeah, recently I was reading threads on IDFC. There, one investor raised a question on the credit underwriting part. Like he was saying, the people who was doing underwriting are not up to the industry expert. So, what's your take on this?
I think I have clarity. Hello, are you able to hear me?
Yes, Anish.
Yes, so I think I have clarified that in a multiple way. So in the worst of the worst credit down cycles, we saw that IDFC was able to maintain their credit book, maintain their loan book at a very reasonable credit cost. So I think that is pretty clarified till now. So there's this bias that gets created because they see what happened in Capital First. So in Capital First, as I mentioned, they used to write off a lot of loans. But you have to understand, why did they do that? They got their real funding in 2012, and from 2012 to 2015-16 they were trying to perfect the lending that they were doing. So the IP that they talk about today, it didn't really came up like from overnight. No, it took a lot of time to build. It took a lot of data crunching to build. It took a lot of time to understand where should you avoid to go, the places where you can die. It takes time to understand that in the market. And that's what is the moat that we are talking about. That if anyone tries to come about and start retail lending today, it won't be that easy. If it was that easy, then we wouldn't have one Bajaj Finance. So that's sort of a thing that we talk about. And yes, obviously credit cost of IDFC was similar to Bajaj Finance in this down cycle on the retail side. So when they talk about their credit underwriting being bad, I think they are referring to Capital First when they were experimenting with a lot of things and they were writing off, obviously. So I think people need to update themselves as to what exactly is happening on the numbers side. And obviously, when the stock price doesn't perform, everyone can bring up many allegations. As I mentioned at the start, like you can give me any company from the 5,000 companies out there, and I'll tell you 10 different reasons to not buy it. 10 different reasons I'll come up with that. So that is a thing that you need to keep in mind. And obviously, there will be variant perceptions. So as an investor, that's what is your work. If everything was already into the price, where is the alpha? So that in that sense, you have to do the ground level work and understand what is being priced in the market and what is the reality. If the reality is much better than what it is being priced, then go forward and take a big position and take that risk of you being right or you being wrong. You'll know with time for sure. Yeah, should we move forward, Prince?
Yeah, Anish. Yeah.
Thank you.
Yeah, yes, sure. So the next company, one second. The next company that I'll talk about is Krishna Diagnostics. I think I have already talked about a lot about this company in my Twitter profile. So I truly believe that this company is sort of the DMart of diagnostics. Why? Because they are able to do the same set of diagnostic tests at like 40 to 80% cheaper rates. We'll try to understand how are they able to even like do that. Like that's sort of a cost advantage is extremely hard in a highly competitive business. So firstly, we need to understand like where does the entrepreneur come from. So Mr. Rajendra Mutha, who's the chairman, and even today is like just 48 years old. Previously, he started with being just a pharmacist in a government hospital. And while he was doing pharmacy, he people understood, and he also understood that he had a very strong business mindset. And using that business mindset, he increased his pharmacy business from one center to 13 centers over time. In Maharashtra, he was majorly focused there. So over time, he understood one thing through a situation which happened where a lady, a very poor lady, she had to sell all her goods and land to save her son's life. And for what? For getting the diagnostics done. For a single MRI scan that you do, it usually costs 10,000 rupees. And for a person, for an average Indian, 10,000 rupees is like his monthly earning. And for any problem, for if you have any head related problem, head related injury, you would have to get two MRIs, 20,000 rupees of money just on diagnostics. And he saw that with many patients. He saw that like uh, people have to sell their goods, people have to sell their land to get the basic healthcare done. Yeah, any doctor won't even talk to you without the diagnostics reports. He understood that there is a business there, and that's when he went into it. We have other competitors. We have Dr. Lal, we have Metropolis, we have Thyrocare. So these guys have been there in the business for the last 30, 40 years. And the thing that you see today, with Dr. Lal having 2,000 crore revenue, Metropolis having 1,200 crores revenue, Thyrocare 500 crores revenue, it took them that much time to reach there. This guy created the business of Krishna Diagnostics in just the last 10 years. From 2012 to 2022, they have already expanded to 500 crores revenue run rate. And obviously, there needs to be something that he is doing very much differently than the market to be able to gain market share at a rapid pace. 5 years back, Krishna Diagnostics was just 0.1% of the total diagnostics industry. Today, it is 0.6% of the total diagnostics industry. The rapid market share gain doesn't just happen. You have to understand there has to be something different in their business model, which others are not able to capture. And I believe there's a very strong right to win, which we will discuss. So 100% of Krishna's revenue comes from hospitals. And basically the hospital related diagnostics is majority of the diagnostics industry. For example, if you go to a hospital and the doctor tells you to get these tests done, so you have to get it done in that particular diagnostic center only. You won't really go out and get to a Dr. Lal or Metropolis and then get the test done and then come back to the doctor, because you want to do it immediately. So Krishna's business model is related to that, and on 70% of the revenue that comes from government hospitals. So how do they get to the government hospitals? So there are PPP contracts, public-private partnerships. There are big contracts, small contracts, where the government outsources its diagnostic chains of public hospitals to private players and asks them to manage themselves. And basically, what's the cost saving of government? It's firstly the operational cost is not there, and also the equipment cost that you have to put in a lot of tens of crores in a single hospital. That's not there. That's totally outsourced to Krishna. So Krishna, what they will do is like they also have to just invest on the equipment, and they will get like a 5 or 10 year or 12-year contract to manage the diagnostics of that particular center. And land related costs. So for example, an average diagnostic center has to be where the talk of the town is, where the majority of the crowd is, to showcase their brand and everything else. Krishna doesn't have to do any marketing costs. Krishna doesn't have to do any land rent cost that any other diagnostic centers incur, which is normally 20 to 30% of their revenue. And because Krishna is in the hospital, they do not have to write checks to doctors to get the business. Normally, if you'll go and talk to the people who are the doctors or the MRs who interact with doctors related to the diagnostics, they pay 30 to 40% of the revenues to doctors to get the business from them, to buy that doctor's prescription pad, which is very much common even in Indian generics, so Indian branded generics. So these are some of the cost savings. Other than that, because Krishna is buying these MRI machines, CT scan machines, which are very expensive machines, anywhere from 2 crores to 25 crores. They are buying these machines in bulk. They are buying like 40, 50 machines in bulk for a single contract and stuff like that. They get a big discount on it. So when I had a meeting with the management, there was a big team from a very reputed diagnostics equipment company there with their whole team to discuss the contract details. So because they buy in bulk, they get a big discount there. And also in the CMC contract, which is basically the maintenance of these machines, they also get like 25-30% discount there too. So when you bring in a lot of these things, Krishna has created a sort of a dominant nature in the PPP space. For example, 100% of the contracts that they bid for, they are passing the technical rounds, and then they're also winning the contracts 80% of the time. The second competitor of Krishna is in like 3 to 4 states. Krishna today is on 17 states, and they are able to do their business profitably, 30% EBITDA margin business. Interestingly, what has happened is that some of the competitors who had won previously, they had to leave the business because they weren't able to do it profitably. So the government called Krishna to get to it and complete it. So in the diagnostics industry, people we talk about there's so much competition entering. So everyone says that there is no entry barrier, and I agree with them. There is zero entry barrier in a diagnostics industry. But what you need to look at that there are humongous barriers to scale. Opening a diagnostic center in a single place, it's very easy. Anyone can do that. But now from taking it to from 1 to like 100 centers, and from 1 city to 2 cities or 5 cities or 10 cities, it's humongous. The pain that you have to incur is humongous. You will see that in India there are 50 to 60 diagnostic chains who have just reached a revenue of 50-60 crores and then stopped because they weren't able to expand to a new region. And that's where these Dr. Lalpath Lab and Metropolis are acquiring these small players, paying top dollar for them to become larger, because they also understand that if they go and try to capture their market in that regional area, it's extremely tough for them to do. So in diagnostics, if some player is able to do business across geographies and they have cracked that code, whether be it through their systems that they have developed or XYZ, it's a very, very big deal. And once you have cracked the code, you are on the path to become dominant. So why won't any private player come? Because Krishna is now doing 500 crores revenue. So why won't like Dr. Lal or Metropolis enter this business? So we have to consider that they had this opportunity to enter this business since this business gained scale from 2000, from FY15 to FY22. Everyone knew about this business, what was happening, how much money Krishna was making, and even more so today. But they are not entering this business because Krishna, as I told you, because they are saving a lot in their costs. Krishna is creating a price advantage. They are at 40 to 80% cheaper compared to market in most of the tests. And that is something that Dr. Lal or Metropolis or other players do not want to do, because they will be competing with themselves at a price which is 40 to 80% cheaper. How can that happen? They would have to create their own brand. They would have to create a whole business vertical with a very much different mindset than what they are today, which is the effort like who will take, because they have already created a lot of wealth for themselves. Do you think that they have that mental capacity to go about and start building a business there? The probability of that happening is next to negligible. They will have to start a new business from zero. And who knows, like, you have to manage two different businesses at the same point in time. It's not really that every business is similar here, because working with the government is a totally different ball game. And Krishna, in many multiple ways, they are able to manage their costs. For example, even in terms of like the people they hire at the center level, currently they have like 2100, 2200 centers already, which is a very big deal. So they are hiring them on a revenue sharing basis. Like, you get me business and you take the revenue. The fixed part is very low. So multiple ways they are able to manage their costs, multiple systems that they have built, their layers and layers of work that has gone to crack this business model. And this is not something that is extremely easy. For example, Thyrocare failed in this business, in the government B2G business, because they weren't able to manage the extreme overheads that were getting created at different villages. So Krishna is going to the rural of Bharat, like to the extreme ends of Bharat, and providing diagnostic services. For a player like Thyrocare, they weren't able to manage their costs because, as I told you, it sounds easy to enter this business, but I think recently Mr. Aditya Khemka sir, like released a report where he mentioned of two new players. One was a tech-related diagnostics player, and another was Mankind's diagnostic chain, which is Pathkind. After 8 years of business, they are just at like 80 crores revenue with 50 crores of loss. It takes a lot of time for a diagnostics player to scale, and because the systems, to build those systems takes a lot of time. And that is something that you can observe even in DMart. Like, DMart took 10 years to open their first 8 stores. Why did they do that? Why didn't they just go for like PE money and like open 500 stores in like 5 years? which every other QSR chain wants to do today, or every other retail chain who failed did. Because they want to perfect everything. They want to perfect the system such that it becomes scalable after that. Once you have a framework, then you can scale it up. Many people get lucky once, but if you do not have a framework, you do not have a system, you will not get lucky again and again. You're done. You always need to look at frameworks. Those are the key to success, and that's what Krishna has done. They have perfected that system over the first 4 or 5 years, where they were focusing majorly on few states. After that, now they are scaling up like massively. And another moat that this company has is like the capex investments that they need to do. For example, if you're buying machines, those machines, as I told you, are expensive. So expensive machines, maybe you have to invest like 50-100 crores in a single contract. Not everyone can do that, because 50% of Krishna's revenue comes from the radiology side of the diagnostics business. So the diagnostics is divided into pathology and radiology. For radiology, CT scan, X-ray machines, and other stuff are there, which have a much higher gestation. So if you'll open a radiology center nearby, the gestation period for your money back is nearly like 6 to 7 years. For a pathology center, it's normally 2 to 3 years. So very few people want to go into radiology in the first case, because like as simple as that, it will take a lot more time to get the business. For Krishna, it doesn't matter, because from day one they are receiving all the people who are coming to government hospitals. And if you have ever been to a government hospitals, you will see that there is always a line. In most of the cities that I've gone to a government hospital, there's always a line. So that's where from day one, Krishna is just getting the customers. Like, they do not have to put in any effort. So even Yash was telling me that like their marketing cost as a percentage of revenue is less than 1%. For others, it's like nearly 5-10%. They are getting, and other than that, infrastructure that they have built, fully integrated IT infrastructure, and you can see it in their systems. You can see it in their IT costs, which are much higher than the industry when it comes to as a percentage of revenue. The main moat, experience of managing logistics. As I told you, barriers to scale. They work through an extreme network of hub and spoke model, which is very much in line with other players, but they have done it in the deepest corners of India, which is something that is extraordinary. No one else on the listed side and the unlisted side I have seen has been able to crack that. Other than that, yes, why would I call them the DMart of diagnostics? That was something that we need to discuss. So as you see, they are at the lowest. They are at the lowest cost when it comes to providing the tests, and that not just lower by like 5%. They are lower by 40 to 80%. And what happens? What happens when a DMart store gets opened in a particular locality? It eats up majority of the business that is being captured by the other smaller retail stores. That's what happens, because people go and talk to their friends about these services being so much cheaper than the market. And slowly and steadily, that's what is happening, where mouth to mouth publicity is creating a strong moat on a local level for Krishna. And that mouth to mouth publicity is like bringing the business without doing anything. So basically, even in the urban areas where they are open, what they have seen is that once the centers mature in the 2 to 3 years at which they mature for them, they start seeing 40 to 50% of the people are private walk-ins. They just come to get the test done at Krishna, because Krishna is providing the same test at 40 to 50% cheaper rates. And you can always come at a uncommon hour to get where the line is much lower. And that's what they are seeing. And that is creating a very big brand without doing anything for them. And obviously they are very small today. Like even in their state where they are like most prevalent in Pune, people do not know about Krishna. Like my relatives do not. So there is a long way to go. Currently, they are just like 0.56% of the industry. But we need to understand not where they are today. We need to understand where can they go over the next 5, 7, 10 years. And do they have that strong a moat? Do they have that fire in the belly? And that fire in the belly is pretty visible with the growth that they have showcased in the past 5 years. 50-60% CAGR is common for them. And if you study the pipeline of orders that they have won, and as and when the orders will ramp up, which will happen over the next 9 to 12 months, and additional orders that are in pipeline. For example, there is a Rajasthan contract, Rajasthan order, which is of 3,100 centers. That particular single contract is of 3,100 centers. Krishna's total size today is 2,100 centers. And if you study the competitors who are competing with them in the same contract, you will understand how easy would it be for Krishna to win that contract. Because the second largest player in that particular contract who's bidding for it is not even 100 crores revenue. So the probability of Krishna winning, and they are pretty sure that they will win, is very high. And they are, obviously, this is just one contract that I'm talking about. Krishna has very big plans for them to grow at least for the next 2 to 3 years, of which I know about. And so revenue visibility is there. You have like contracts for like 5 to 10 years with an inbuilt price escalation. Normally, these are very high gross margin businesses, 70-80% gross margin businesses. So even if your raw material grows at like 7-8% year over year, your total revenue wise, you will be able to manage your costs if you increase your revenue by 2-3%. And that's what it's normally built into the contract, so you do not even have to worry about that. There's also a renewal clause where in most of the contracts, because if they bring in a new player after the 10-year ends, then that new player has to incur the cost of taking the machines out, putting in new machines in, and then running the whole business again. So most of the times it will be Krishna who will be winning the contract. There's always a risk of repricing where the price the Krishna would have to bid in the renewal contract will be a little bit lower. And but that's not a risk, because all the for example, the capex that they have put in, like, for imagine a single contract where they put in a capex of 100 crores. Over the next 10 years, while the contract is going on, they have already depreciated the whole assets. So the incremental revenue and profit that they will get from that particular contract is basically 100 infinite ROE for them, no? So if they are continuously getting new contracts and they are able to replicate this business, it's like a 20 year sort of a business fixed, where you're getting this business. And it's on an average for matured centers, which are like 2 to 3 years old, you make a ROCE of 30 to 35%. And that can also see an expansion, which I'll discuss. But just imagine, like, currently 66% of the centers are already mature and which are making 35% ROC. Other centers are not mature, which are making single digit or negative ROC, and that will change. So and on the top of that, on building on top of the 35% ROC that they already have, they are thinking about going into B2C business. So what they will do is that the main center is already there. You just have to give franchisees to the other collection centers, which will bring business to your main center. And because your pricing differential is so high, you can still give a discount compared to the private market prices, like 20-30% discount, I think should be there, and they will give it. And they are trying to capture the B2C business too. So on top of the base that they have, they will try to capture the whole B2C network that they are creating. It's a 5-year journey from where it's not going to happen tomorrow, but that's the next leg of business. And that is something that we have seen with the best of the best managements now. You don't know what the business will look like 5 years down the line. If the business looks the same, then the management has failed. Because in such a dynamic world, you have to consistently innovate yourself to become a much better business, much more anti-fragile business, and that's what Krishna will do. So as I talked about the zero doctor referral fees. I think we'll just move on to some of the risks that I see in this business. Yeah. Any question?
Not a question from my side, actually. I want to add a couple of points along with you, Anish, because I have worked in the Philips Healthcare, which in the MRI department of means almost 7 years there. I left that company a couple of months ago. So adding a point, like another metrics which we track in Philips MRI the utilization of the MRI machine. So basically with the exams, like how many exams they are doing so per day. Hmm? So that number also matters because that is directly linked to revenue. Maybe one wants to track for that also. It impacts the revenue. Other one is the value add-on services like fMRI, Amdixon sequences, which are called the protocols there, which goes with the every kind of exam, and it depends on the diagnosis what they are going to do, the hospital. The third one is the type of MRI they are using. So the current new technology are coming. MRI uses the helium actually inside it to cool down uh, the heat, liquid helium, and that is the recurring cost for the diagnostic center because it up to a certain level they has to again refill it, and that comes with the cost. Okay, and that is not part of the usually the contract which the diagnostic equipment manufacturers provides. So now the new technology is coming in that area with the blue seal magnets. So they don't, it's helium less. So that cost again, the diagnostic center, they save the cost with that. So certain things which we can look, while tracking the, especially the radiology imaging industry. As part another point which I want to make, I don't know how many people here knows about it. That MRI doesn't harm the human body. It works on another magnetic principles of electronization and other things. Where CT is cheaper than MRI, but when somebody goes for the CT, and CT takes less time. So one CT can be done in 5 to 10 minutes, where one normal MRI goes about 30 minutes to 1 hour. And if the patient moves in between, then again the process has to be repeated. Maybe sometimes some protocols, maybe sometimes most of the protocols, the whole exam has to be repeated. So there, one CT, if somebody is going, it's almost the dose, radiation dose is almost more than 200 X-rays at a time. So people are now moving towards to MRI because of the radiation it causes from the CT. So yeah, those are the couple of points I wanted to mention just for the sake of the people who doesn't know about this, just to add on the knowledge on that part.
Thank you,
Thank you so much.
Thank
Yeah,
you for
thank,
limited
thank,
time. Yeah, Anish, we can move on to next stock you want to discuss. And Ravindra, anything you have?
yeah, matlab,
Uh,
I have a lot. I have some more to say on Krishna.
Yeah,
uh,
yeah.
I haven't really discussed the antithesis.
Anish, one thing, yeah. Uh,
Hmm.
how which can you share the name of the competitor? You're saying that the second best is about 100 crore. What's the name of the other companies in the peer set who do B2B?
Yeah. So the other competitors are Medal Healthcare, Spandan Diagnostics, Health Map Diagnostics. These are like very much regional players who are much more focused on few states. And yeah, so they are not on a pan India basis, and they are all privately owned. SRL is there, but SRL is like in a I think in a very small manner in two states. So none of the other players, which other players are there. None of the other listed players are there. Thyrocare was there. It closed down that business majorly because it wasn't able to run it profitably.
Okay. And when we say within a private hospital, ITNA will have their setup, right? Because the land cost is taken care by the government. So,
Yeah, for a government hospital, they are there. Private hospital, like 30% of the revenue is there, where they have to share the some part of their revenue to the private hospital. Yes.
okay. And so from government hospital, when they're present, they can't book a revenue which is coming directly in their book. They have to route it to government only, right?
Yeah, majority of the revenue does go through government because like that's how the contracts are set. Majority of that is for the people who are not able to afford diagnostics. So that's why government is the payer there, and 70% of their total revenue is approximately that. But slowly, what we are seeing is that like the private walk-ins are increasing, where the revenue is cash. So that's something that consider.
And this 30% is the center which is located in the private hospitals.
Yes.
How much, if you know, I know these are very intricate details, but how much is the difference between pricing in once it is in the government hospital of the Krishna versus the private hospitals of the Krishna? If any view you
Uh, I have checked in a few hospitals. It's normally 15 to 20% higher. So mostly the pass on that they have to do to the private hospital, they increase the prices by that much, but still they are lower by 20 to 30% compared to the market.
okay, okay, yeah. Understood, understood. Just one
And
thing,
yes, yes,
Lalur was here. I wanted to ask
yeah.
him one. When you go for say radiology equipment and say pathology equipment, which is there on the farm, on diagnostic centers, what should be the shelf life, average shelf life we should discuss, consider? How many years it should be normally be depreciated, or they can be very long shelf life equipment?
Yeah, so normally, like the management has mentioned that the life of the assets are 20 to 40 years, depending on the particular asset. We can take a base case of 20 years, but they depreciate it quite aggressively. That's when we say, na, because when the contract will come for renewal, they are going to work with like zero capital, and that zero capital will make them whatever money it does, it's like 100% ROCE business. So that's what we need to consider. On the working capital side, yes, people could have questions that government is not paying them back, but if you check the real working capital, it's less than 30 days. They are able to manage the payables, receivables quite well, and on the payables and the payables, they are able to manage that absolute working capital very well. So that is something else to consider. So capital investment is not a factor here, and even when it is a factor, this company has like 300 crores of net cash in the balance sheet, so shouldn't be an issue. Yeah, last year they made a
Adding
FCF.
to Anish's point, so no MRI, a good MRI comes nowadays below five crore. Specifically, I am talking about MRI. And the companies, especially I know about Philips and Siemens and GE, they don't support more than 10 years. Means the system will still work, the software support will not be there after 10 years. So that is the standard they are following because they have to launch new products. So some product will go for the end of life. But MRI will still work.
Yeah, definitely, definitely. And Deepak, like if there's a company which is buying like 20 MRI machines from you, wouldn't you give them a 20% discount on it?
So see, this is all the part of the negotiation with the pre-sales team and after-sales team and all those things. But what I can add here that nowadays a new trend is coming in the diagnostic, equipment manufacturers, which is pay per use. So they don't take 5 crores well in advance for an MRI, let's say. So they say you do the scan and I'll take a part of your scan because your data will come to me and I know how many scans you are doing and how many are the repeat scans from that. So they are, and what type of customer you are also, that is also a key metric there, that you do a lot of pediatric or you do a lot of, brain scans, or, which anatomy you are scanning most of the times. So based on that, they add the value add-on package as well. And that is again impacting the revenue for the customer, which means the hospital as well as for us like Philips or Siemens or GE. In MRI, the Siemens is a leader. Number two position is held by G, and number third is held by Philips. These three are the main, although there are Toshiba and Samsung, they are also trying to come into that industry. They have some product launched also. If somebody knows about, wants to really read about a lot of radiology things, then there is a RSNA. Every year it happens. You can Google it. You will come to know what is actually coming in the MRI industry, because in RSN is like a roadshow where every company comes up with their products, they launch and they demonstrate what they are going to do and what they have done. They really demonstrate with the live product and working prototypes. So RSN is nothing but a radiology Society of North America. That is RSNA. And
Yeah,
yeah.
yeah, thank you so much, Deepak. I also wanted to discuss this. You brought up a very good point. So currently, what's happening that you don't have to put in the full capex for majority of the machines that you buy. You can also have some sort of a subscription based model, and that's what I believe Deepak mentioned. So that also creates a strong point for Krishna, because now they do not have to put in that much capex, and still because they are putting in so many machines, they are able to negotiate much better terms compared to any small competitor who wants to come in now because they are seeing a lower capex being installed. So the systems, the lower capex, and the whole way the business works, it's something that you need to consider. And one thing, like Mr. Velumani in his recent spaces said that you can't do a diagnostics business in the rural India without the help of government. So that's where the that's where you understand that there is also that right to win, while where no other private player would be able to come in here without the help of government, because the cost structure will be so high you won't be able to make up the money. And that is another way in which Krishna creates some moat around itself. So yes, it's a absolute bet on the healthcare industry in India, and the whole pie will expand, and this company will continue to increase its share in the industries. For example, in rural India, 65 to 70% of the people currently live. Still, it's like just 25% of the total diagnostics business, because it is heavily underpenetrated even today. So you understand what sort of a thing will happen here. And also value migration from mom and pop stores. So very few people know this, but like 50% of the Indian diagnostics business happens through small, very small centers, like one center chain or like five center chain or like very regional chains. And slowly what is happening over the last 5 6 years, and due to this only the diagnostics businesses get such a high valuation, because there's a very high value migration. So the large diagnostics chains today are just 5 to 6% of the total industry, and the unorganized is like 45 50%, and that migration is happening, and that migration will continue to happen. If you see the larger developed nations, the organized sector is like for 50 60% of the total industry, and that is another trigger for these companies to continue to gain market share. So they will all the whole pie will increase at 15 16% rates, and these companies, the larger chains which have very systematic processes, digital systems, and very low cost basis, they will continue to gain more market share. And Krishna on top of it is building more bringing more contracts into the picture, where they can scale up multifold in the next 2 3 years on top of this. So there's like a very tiered structure where I see that Krishna is placed much better compared to the whole market. Yes. So on the financial side, as I told you, like this is a very high margin business. Any diagnostics business you will see, it's normally 30 35% EBITDA margin business, 15 20% net margin business. So you don't have to worry about that. The worry in this business was only the working capital side, which is something that is Krishna able to manage, and that is something that we need to follow going forward too. And obviously there's a negative operating leverage. So if Krishna is growing at such a fast pace, fast pace, they are getting new contracts from here and there. For these contracts to ramp up to break even, it takes 6 to 9 months. So do not expect a very strong bottom line growth over the next few quarters. But what you can expect is that the revenue growth will continue to scale up, but the main profits will come like 2 3 years down the line. That is something that's a risk for a short-term investor if he's focusing on making a quick buck here. Uh, and obviously, it's a B2G business. There is no denying that if government changes some rule or the other, that could create a problem for you. And that's where the management comes into the picture. Are you comfortable with that management being able to turn around when the time is needed? Because the waters will always be volatile. You don't know. It's dependent on the captain of the ship, and you have to understand, is the captain capable enough to manage through the volatility that will happen. So that's a call that you take. And other than that, we have already seen one of the risks play out in terms of a sector-wide derating. You might have already observed that all the diagnostics players in India stock price have been down by 40 to 50%, because they got like a lot of COVID-related revenue. Now it's all gone, and it will take, the market has realized that it will take nearly 1 year for them to revamp their revenues back to the COVID revenues, which was FY22 revenue. FY23 will just be taking their non-COVID revenue to match the last year's revenue. But for Krishna, it's already done. So for Krishna, in the last quarter, in the last to last quarter only, they were able to capture their COVID related revenues in the non COVID revenue, because the non COVID revenue grew at 70% year over year last year, last quarter, last to last quarter. And this quarter it had a lower growth because last year this base was a bit higher. And you will see that Krishna from here on will show a year over year growth, and that should happen. And obviously they have given a very strong guidance too of like 2x revenue in the next by FY24, and a bit higher margins. But I don't know about margins, but I think the revenues should be doable with respect to the contract wins that they have done recently. And the other risks are, yes, other risks are there of regulatory and political changes. So this is a black box part of this business. You don't know what exactly is happening here. Other than that, the incremental competition we need to be cognizant of. As I've already told you, there's a very strong right to win, but there will always be incremental competition which we need to focus on. So that's another risk. Employee attrition has been a bit high for them, which is 22%. That is something. But other than that, I think the promoters are extremely young, like 40 to 48 years of old for everyone. And they have that fire in their belly to want to grow to become a much larger company. In 10 years, what they have created is something extraordinary. And I'm just excited about like where will they be in the next 10 years. And that's what you need to focus on, like young managements who have that fire, who are you are getting them on the valuation side. You're getting today Krishna at like 20 times earnings, where they can easily grow their earnings 3-4x in the next 2-3 years. So it's extremely cheap with respect to the unit economics of the business, which I have already discussed, of a diagnostics business and the market potential that you have. So yes, the conclusion is that yeah, it's basically I'm pretty excited of this company. If you have any questions, then we can have that on any of the diagnostics related company or industry or whatever.
I just
Yeah,
have two
yeah, yeah.
mates, and then maybe one question when you meet Krishna's management or someone there, you can ask. Generally, what happens? This is for audience. Generally, what happens when you invest in a B2B or B2G kind of business, you don't take a very long visibility. That's why the PE multiple are lower in these kind of business compared to B2C. Say if you are choosing a company which is FMCG, you can take a 20, 30, 40 years kind of view, and hence the PE multiple reflect that kind of observation. But when you pick a B2B, B2G kind of companies, you will take a very shorter time frame that I can understand that not, the business is, I can see the visibility of the business with the government or the B2B side for this initial years. And if the business grows in those years and the contract get renegotiated, that is the alpha you make, because the market perception normally remains that B2B business remains a low P multiple because you don't have a higher visibility. But if the business sustain that time period, after a couple of years, they sustain, renegotiate the contract, and they are still in the business, and whatever other growth which comes into the business, that becomes your incremental return which you can make with this kind of investment. So you need to take that call. Other thing which I wanted to say is when Anish meets anyone from Krishna's side, one thing I have a doubt, because normally a government, when they will issue, they will do any kind of business, they would do something kind of L1 kind of negotiation. So we need to see what kind of margin other companies, B2B providers are making, and how they are able to generate this high margin when the working style of the government would be something kind of L1. I understand the part of efficiency from the Krishna, but still this margin is bit high. So maybe if we meet management and they throw some light, and how the peers are making, if we can check those data, it will provide more comfort in our thesis.
Yes, Ravindraji. The thing is, like, I've seen some of the peers' numbers, and there the margins are pretty bad in terms of comparably with Krishna. I believe that's also a function of scale. I've seen the margins being 5 to 6% net margin. For Krishna, it's like 15%. So I think they are pretty small compared to where Krishna has reached. So negotiating power and many other things that we discussed, there's a big differential there. And in terms of Krishna, yes, in a B2B business, as we have discussed, the contracts that they are getting, they are going to stay for a long time, but the market perception is something that will most probably be on the short term or a medium term basis, because the unpredictability will always be there, and that's a risk that's there. So even if that risk doesn't play out, well, that risk plays out and we never get a valuation multiple from here, 20 times earnings multiple, I see if the management has the potential to grow at 30-35% CAGR, where there could be a little bit of operating leverage to play out, because the basic overhead at the headquarters level are not going to increase. So on a center level, they make a EBITDA of 40 to 45%, and when you add the overhead of the headquarters, it decreases to 30%. But that will not scale up with respect to the business scale up. So some operating leverage should be there, and with that, I think that the CAGR that one can make is reasonable enough for them to take this risk. Yeah, Prince, like, do we want to do the Q&A now? Because I think it's already a bit late. So we can do a general Q&A now, and we can do another spaces to discuss more companies.
Yeah, I was about to ask the same thing. We can discuss the remaining bets in next session. So
Yeah.
basically, yeah, Anish, I take a few questions from the comments, and so okay. So
Please.
his question is like IDFC is they have savings account with minimum 10K or 25K balance requirements. So do you think they are competing with large banks for customers instead of focusing on public, which is mainly with PSB banks where minimum balance requirement are less? Even HDFC has a minimum balance requirement of 5K.
That's a really good question, and that's a call that the management has taken to focus on people and customers who become substantial, who give substantial business to them, and that's a primarily call that's taken by the management, and they believe, according to them, that it's like if a person on any average person should be able to put 10,000 in a bank and keep that with the bank, because they are also giving a lot of extra added services with that, and they're not charging you for those extra added services. For example, with my debit card, I get a lounge access on a domestic airline basis. So very few credit cards give that. Not all credit cards also give that. So they are giving a lot of value added services, and on that value added services, they want a higher balance requirement, and that's just a call from the management to focus on a slightly higher value customers at this point. But I believe they will come up with a zero balance account too with time. Currently it's there, but it's not marketed enough. But as of now, they're focusing on the relatively high value clients. And also the average balance that IDFC has, one second, just average balance that IDFC has is over 1 lakhs with a normal customer, which is a little bit higher than averages of the other banks. So yes, another pointer to support my thesis.
Another
Just
question. Yeah,
Anu,
1 second.
ICICI also has this minimum balance of 10,000. The account which I have is a minimum balance of 10,000, and if you don't maintain that minimum balance, the penalty is some 500 rupees every month. What I heard from someone, IDFC, the penalty is only 50 rupees if you don't maintain that 25,000. So yeah,
Yes.
it's friendly, I would say.
It's relatively very low compared. They are not their main philosophy that Vedanthan always talks about in his annual reports and in his messages to his employees. It's about like think your customers as your family members when you're selling them products, and that's the main core philosophy with which they design their products. So they do not really want to charge the customers a lot. I think they will start doing it a bit now because they want to manage their costs a better. But I think the basic philosophy is giving the customer a much better experience with respect to what they are getting currently.
Right. Another question, Anish. It's like on the equity dilution. Do you think they have already diluted very much? So in future, if they have to dilute equity for funds, then it will hurt shareholders' returns. What is the current bond yield on their bonds?
Yeah. So the last question first. So the current bond yields are now in line with a AAA quality bond. So you shouldn't have to worry about that. That actually, when they did the merger, it was pretty high. It was I believe, 200 basis points higher than the AAA rated bond. But since after the merger, in the next like 6-7 months, it got down to that. So that gives you the idea that bond market is pretty much okay with them. So that's not a risk that we should be worrying about. And if that's a risk, then we should never be investing in such a financial institution for sure. If the bond market doesn't agree with you, then be careful. Because bond market guys do a lot more work compared to the equity market guys, as much as I have understood with my time in the markets. On the other side, yeah, what was the first question?
On the equity dilution.
Yes, equity dilution. Yeah. So on the equity dilution, yes, they had to issue shares to safeguard themselves. So as I mentioned, they were the first ones to raise equity when COVID hit. You can say that it diluted your shareholding, but then think if you are in the shoes of the promoter who's running the business. No one knew what will happen due to COVID. No one knew where the credit cost will land. Where will it land at 5%? Will it land at 15% or 25%? No banker had any idea. So to be on the safe side, they had to dilute their equity, and obviously because the share prices had corrected, they had to dilute their equity below book value. So that's something that they did, and there's no right or wrong here. It's just that it happened. Currently now, from here on, they are showcasing a 9% ROE just last quarter, annualized ROE, and the trajectory of the ROE will continue to go up. That is something which is very clear. Like 5 quarters down the line, their ROE was like 2% or negative. So the trajectory is clear. The market is understanding slowly as to what sort of an institution IDFC First Bank is becoming, and what is the end goal ROE which they are destined to reach with respect to the unit economics that they are working with today. So that's getting clearer. And on top of that, the market is seeing that this company can continue to grow at a 20-25% loan book growth for the next 5, 7, 10 years, bearing a few crises here and there, which will always happen. So that sort of the profitability that you will get on the bottom line is like an ROA of 2% or a bit higher than that if you do the unit economics math. So the valuations that they will now get on a market basis, I'm hoping that it gets re-rated, which it definitely should, because they have showcased in every manner how they are creating a very strong financial institution. I'm not comparing it with the others. I'm just saying on a standalone basis, they are very strong. They're getting there. And slowly it's getting understood, and the re-rating is happening. In this year, they wouldn't have to raise capital. So that is something that works for us. And you will see that by the end of this year only, they will be able to showcase a double-digit ROE. They should do it by the end of this quarter only, but let's see. So that should lead to a much better valuation, which is like an average private sector bank in India gets a 3.5 times price to book valuation. So if that is something that they get, and obviously they would have to dilute, because their ROEs, even at the max level, it will reach as 15-16%. So if they are growing at 25%, they would also have to dilute to grow that fast. So I'm hoping that the valuation that they reach for dilution next time will be a lot higher than they did previously, which was like 2 times. So hopefully the next dilution happens at a much better pace, a much better valuation metric in terms of price to book, and that works for all of us as an investor.
Yeah, this dilution thing. Look, the status is this. Their capital adequacy is about 16.5%. Kind of ROE, and if loan book grows at 20-25%, you are consuming 8. So if from 16.5%, you are consuming at least 150 bips every year. So in next 2 years, after 2 years, within 2 years, they will definitely fundraise. The other caveat on this logic would be if, say, monetization or IDFC mutual fund comes in, they are post tax, they will get some 3,200 crore. And if the reverse merger is allowed by RBI, they will use this 3,000 rupees will be about 20% of the capital. So this can provide you a lever for next 2 years of growth. But the pace at which they are growing, and the ROE says every 2 years they will need the fundraise. So that shouldn't be, because if they are growing at that high clip, बिना पैसे के तो बैंक ग्रो ही नहीं कर सकता यार, so it's that way.
Not possible. Yeah. मतलब, capital raise, so it's a part of the bank. Capital is the raw material for a bank. So without the capital raising, they will continue to do capital raising, and people look at like 600 crore shares that IDFC has and point out that it's too much equity. That's no, that doesn't matter in the grand scheme of things. The number doesn't matter. It's just about the business trajectory. Where does that go? And that will be the core driver of your stock price and everything else. So let's just focus on the business fundamentals and not the dilution part. If they are doing the business right, they will get a right valuation, they will do a right dilution, and we all be very happy investors.
Right, Anish. So, Ketan, you can unmute and ask a quick question.
Jai Hind to all on this space, and thank you, Prince Bhai and Anish Bhai. You are too good on the analysis part. Few things wanted to just to add. IDFC First Bank. I have not seen any management coming on TV and selling his own products. So I just entered this company while I heard Mr. Vedyanathan selling his bank products to Anil Singhvi. When he launched a credit card and he was selling saving account, he was selling credit card to him. So I didn't had that exposure on the space in my portfolio to add a new bank into my portfolio, but just because of that interview, I added IDFC. Second, on Krishna Diagnosis, just wanted to add few data. Krishna Diagnosis on ground level, even after 40 to 60% discounted price from the peers, they are still doing operating profit margin equivalent to these companies like Lal Path and Metropolis, which are listed. Even after discounted price. Second, as you said, they are now into 17 states. You will see maximum people, the crowd you will see in municipality hospitals. You will not see that crowd in any of the private hospital or any of the charitable trust. You will see the crowd in government hospitals. This is the reach. Only the thing what I have understood from the company side, they are very low on marketing, and even I have experienced it personally. I get my things diagnosed at Krishna Diagnosis. Uh, they are very low on marketing. They, even at municipality hospital, if they are into that building, then only people know about there is something called Krishna Diagnosis. If they are into the premises of that, many of the people don't know there is a Krishna Diagnosis which is giving them on a cheaper rate, whether it is bath or MRI or something. So this thing company has to focus on, even on price to book value. Company is trading hardly 2.5 times, whereas Metropolis and Lal, they are trading at almost 6 to 12 times, more than 12 times of their book value. Even to sales to market cap, if I compare it, they are trading. Krishna is trading sales to hardly four times of their sales, and Lal is trading almost 10 12 times of their sales, and Metropolis is trading at almost 6 7 times of their sales. So still there is two room, and even a person having a fever, a doctor asks him to get it diagnosed. So the scope for this business, this industry is too huge. So I just wanted to conclude with this add-on information.
Thank
Thanks
you.
a lot.
Thank you, Ketan.
No, thank you, Ethan. Like, you are definitely right on the marketing side. Like, it's too weak today, and I'm hoping that the management makes the changes in the next 3 to 5 years. How, as they are building the B2C vertical, they would have to do that, and they already know that very well. That's why they have hired so many senior executives from the B2C businesses, whether be it like Ravindra Sethi, who's now the CEO, and the others. You can check check about them on LinkedIn, and you will see that they are putting in the work to build that business vertical, and I'm hoping it shows some results going forward. And yes, Mr. V Vedanathan is a great salesman, so I do not have to say anything else. After that, he sells a lot of products in the con calls too, and I believe there are a lot of conversions due to that too. So yeah, and because their products are too good too, matlab, in the sense that if you compare it relatively with other banking products of that same vertical, they are giving you a lot more benefits. So why not use them till the time they do give you? Sometime they wouldn't be able to give you. So till the time they do give, let's utilize that.
All right, Anish. So, Anish, next question is like when meeting with Krishna management, can you please get the sense of their approach for private centers, D2C? In their last con call, they mentioned to such no concrete plan for expansion. Mostly, are they aggressive about D2C due to risk migration from B2G?
They are pretty understanding of the fact that this can happen on a state to state level. Some disruption can happen, and that's why they are actively building a B2C vertical on top of that. On the private side, so you have to understand, in the private side there's one caveat to this. So the largest of the largest hospitals that are out there, they would have their own diagnostics chain, vertical or diagnostics chain. Why? Because a hospital's business, in the best of the years, they make a ROC of like 20% on a cycle, on an overall cycle basis. Average cycle ROE is 15 to 20%. For a diagnostics, it is 35 to 40%. So why would a hospital give outsource that to Krishna? So the larger hospitals, they are okay with putting like 20-30 crores into building their own diagnostics chain and doing that. What Krishna targets is the smaller nursing homes and smaller hospitals, private hospitals, where they can collaborate with them and do business with them. So there they are targeting, and they'll continue to grow, and that's where their focus is. So we do not expect a very high growth from the private sector due to just this, because the private sector will have their own diagnostics chain, and that's what they want to do business with. They do not want Krishna because they can invest 40, 20, 40, 50 crores. For the hospitals which are small and which do not have the financial capability to do that, they will partner with Krishna.
Right. One question is on AB Capital, if you would like to take. The person is asking for your views on AB Capital.
Yeah, I do not have much to contribute there. It's just that in the bull market, every lender will do well, and you have to play that, and then you have to make your own decision when the euphoria starts to kick in. Check the history of any lender, you will get a good idea as to do you want to stay there for a very long time, or do you not want to stay there for a very long time. What I like about AB Capital is this is a small business that just got demerged from it, or basically not demerged, got listed as a additional entity, Aditya Birla AMC. That is a company that you should look at. Like, I believe the AMC cycle is not as is at a bottom, where this company is available at dirt cheap valuations. So that's a company that I'll be interested in for sure, but less on AB Capital over a long period. But short term, AB Capital can do wonders.
Right. Any view on Lupin Diagnostics?
Yes. So as I told you, it usually, for to set up a diagnostics chain, it takes more than a decade. So Lupin has that sort of a time horizon, and that's why they are investing into it. I do not think of it as a issue for any other diagnostics chain. It will actually speeden up the value migration from the smaller mom and pop stores to the larger, much more organized and much more efficiently run chains. And that's what is the main idea behind it, the main idea that I have formulated behind it. And that's exactly what's going to happen. It will take a lot of time, and till the time Lupin becomes a substantial player in the diagnostics industry, other players will be much larger. So Lupin is not really a competition to them. It's just like confirming to you that this business is very much valuable to be in. And I believe Lupin and some of the other players who have recently entered into diagnostics industry, they understand that. But obviously, if it was so easy to enter the diagnostics business, we wouldn't have so few large players. And these large players have not been disrupted over the last 25 years. So everyone knew that these large players are making 25%, 30% ROC. So why didn't anyone else enter? The real answer is that everyone entered and they have burned their hands. Because as I told you, entering, there is zero barrier. Barriers to scale, extraordinarily high. Well, it's like it's not very easy. Like even as I told you, like there are two players who have recently entered over the last 8 years, and currently they are in deep losses. Pathkind and some other tech, fintech, health tech player. So you have to consider that. No, it's not. It's a good way to make news and create euphoria around it and create negative sentiment around the sector. But that is a good opportunity to buy because uh, we are not in the business of going 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 towards where the sentiment is. We are in the business to go against the sentiment and make money. So that's what we are here to do.
Right, Anish. So one question is, what is the rationale for buying Varroc beside the VLS deal they have closed? Why and how do you think they will be able to grow their top line and bottom line? Are you bullish on auto sector revival?
So basically, Varroc was one of the companies that I was going to discuss today. So yes, definitely, I am bullish on the auto cycle, and I think I have made it extremely clear as to why I am. So same, it's basically a highly cyclical industry. There is no rocket science here. It's like the auto down cycle started in 2019. It's already been 4 years since we haven't really seen upturn in the numbers. It has just continued to go down. Today we are seeing some numbers are bottoming out, and obviously no one can exactly predict when it will turn around. That's why you won't see a lot of rockets on Twitter unless the all stocks make start to make all-time highs. Some of the stocks have already started to do that, like TVS and ICO. So soon you will start to see a lot of rockets with auto ancillary names. So basically what has happened is like from 2018 to 2000 from 2016 to 2019-20, there were multiple things that caused the pain for the auto sector. So it's like when the NBFC crisis happened in FY19, it led to a very strict lending rules, and 50 to 60% approximately of the total vehicles that are sold in India are financed. So that volumes went away, well, decreased by a substantial amount, and there were higher taxes on fuel, which we have been incurring even till now. More expensive insurance cost and a lot of other factors played its role. Like cost of ownership for a single two wheeler went up 50%. And if you'll consider a normal person who buys two wheelers, they do not have that 25 to 30,000 extra rupees in hand to go about and buy these companies. And additionally, financial sector was having its own troubles. Now financial sector is back. Financial sector is very much open to give auto loans. So a lot of lula palooza effect sort of a thing is happening today, and I think that will be a very big driver for the auto cycle to pick up. So for any economy, auto industry is one of the ways where all the discretionary income goes. And today, as you know, Mr. Uday Kotak recently tweeted, he mentioned that India is at 2,500 crores, $2,500 per capita, GDP per capita. So from here on, you will see that as and when the GDP per capita increases, majority of the incremental growth will go towards discretionary and disposable income, and that disposable income is going to go into buying bigger cars, bigger ACs, and bigger whatnots. You will basically use it in your other things other than your primary consumption. So that is where the auto cycle has to pick up, and we are already seeing some signs, and that's why I'm pretty bullish on Varroc. Particularly, Varroc is now debt free. So once they did the deal with the selling their VLS business, now they're debt free. They have 600 crores net cash, which with the deal will get over by the end of this month or next month. On that, they will do next year sales of like 8,000 crores, and I'm considering a very conservative estimate with respect to their OEMs that they are dealing with. With respect, if OEMs grow, then auto ancillaries grow because they are the raw material providers of OEMs. So on that, you are seeing a 8,000 crore revenue business, which is now trading at like 5,500 crores with 600 crores of net cash. So it's like a 0.5 times sales business today. And we, I think, slowly and steadily market will also understand that if you'll consider the same business with other auto ancillaries which are of a similar size and which do have the engineering capabilities that Varak has. Varak has, I believe, 700 to 800 engineers, particularly focused on designing and building up new stuff. So if you consider that level of engineering capability in India in a diversified auto ancillary player, it shouldn't trade at 0.5 times sales, is what my view is. Other auto ancillaries with similar capabilities trade at 1.5 to 3 times sales. So that's where I want to play the arbitrage, and I believe that's there here. And obviously, because it's an auto ancillary, it's a short-term play. Love you. I won't be owning Varak most probably by FY25. So that is something to keep in mind. Yeah.
Right, Anish. So, Anish, most of the questions have been answered, and we very discussed both the names. So, the remaining names we can discuss in our next spaces. So, any closing remarks or any good books which you suggest our audiences that they could benefit from, and apart from that, anything else you want to say?
Yeah, no, thank you so much for inviting me, Prince. I really liked it. Thank you, Ravinder ji and others speakers who actually helped me in improving my thesis. I would say that. And yeah, on the books that you can read, if you really want to go deeper into understanding what IDFC First Bank's thesis is, read this book called The People's Banker. It's the life story of AP Giannini, who was the founder of Bank of Italy, which later became Bank of America. So you will get a very strong understanding as to what is needed to create such a retail focused bank, and what are the right things to do, what are the wrong things to do. And on the Krishna Diagnostics, I don't really have a book recommendation, but I would recommend another book which is Lifespan, which is a really good personal health based book where you'll get a lot of insights as to how to increase your lifespan. So I think that is it, Prince. Thank you so much for inviting me.
Thanks, Anish. And guys, this session was recorded, so I would request those who have joined late, maybe due to the ongoing match today, so they can revisit what we discussed today. And any questions on well, any contra views, or maybe any questions on the names which we discussed. So you are more than welcome. You can tag us, or you can prepare those questions for our next session. And Anish, thank you so much for sparing quality time. It's almost 2.5 hours, and it was so graceful. We were like, the businesses were explained in so detail that even if a person who is listening the names for the first time can get a sense what the business is all about. So it was great having you today, taking our spaces, and
Yeah,
the
thank you.
valuable inputs given by our guest speakers. Kindly check their handles, and if you find value, do connect with us, so that in future also when we connect such when we host such sessions, so you get a taste of insight shared by various experts. Thank you so much.
Yeah, thank you and good night, everyone. Yeah,
Yeah,
let's
good
talk
night.
next time. Yeah, bye.
Thanks, Ravi and Vajpayee ji, for patiently listening. Vajpayee ji, sorry I didn't. If you have any questions, you can ask. Sorry, I forgot to ask you.
नहीं नहीं प्रिंस जी, कोई क्वेश्चन नहीं है, बहुत ही डिटेल में अनीश जी ने बताया। और ये केवल हम लिसनर्स के लिए बहुत एग्जाम्पलरी है कि मतलब देखिए किसी भी एक स्टॉक को सेलेक्ट करने के लिए उसकी कितनी डीप स्टडी अनीश जी ने की है। तो इसी प्रकार से हम लोगों को भी अपना इन्वेस्टमेंट करने के पहले थोड़ा स्टडी करनी चाहिए, क्योंकि बिना स्टडी के हम लोग इन्वेस्ट कर लेते हैं, फिर बाद में जब डाउन साइड शुरू हो जाता है तो फिर इसमें इधर उधर हम लोग पूछना शुरू करते हैं। तो ये अनीश जी ने बहुत ही अच्छे तरीके से समझाया। और देखिए 2 स्टॉक पर या 3 स्टॉक पर भी इतना लंबा समय तक उन्होंने डिटेल बताया, तो इससे लगता है कि एनालिसिस, फंडामेंटल एनालिसिस करना कितना आवश्यक है। और यदि उसको हम लोग करके करेंगे तो आगे चल के हम लोगों के लिए भी आगे फायदा रहेगा। इससे काफी इंस्पिरेशन मिला है सभी लोगों को। थैंक यू प्रिंस जी।
Thank you, Vajpayee ji. And guys, once again, the names taken during the conversation were purely his thesis and for educational purposes only. don't directly go buy, selling, or hold such names. Understand the rationale behind it. Do your own study, and then you can decide what you want to do with the names. Yeah, thank you so much. Good night, guys. Catch you soon. And we'll be announcing the date for next session when it will happen. So thank you for coming. Thank you for joining. Good night.
Yeah, cheers, guys. Cheers, guys. I'll try to bring in a lot more stocks next time. Okay, bye.